Investing can be a powerful way to grow your wealth over time, but many individuals fall into common traps that can hinder their financial success. In this video, we will explore several key investment mistakes to avoid, ensuring that you make informed decisions that can lead to long-term prosperity. First, one of the most prevalent mistakes is failing to do your research. Many new investors jump into the market based on trends or tips from friends without fully understanding the assets they are buying. It's crucial to conduct thorough research on potential investments, including analyzing the company's financial health, understanding the industry landscape, and considering macroeconomic factors that could impact performance. Utilizing reputable financial news sources, reading annual reports, and following market analyses can equip you with the knowledge necessary to make sound investment choices. Another significant error is emotional investing. The stock market is inherently volatile, and it's easy to become swayed by fear or greed. When the market dips, many investors panic and sell their holdings at a loss, while others may chase after stocks that are rapidly increasing in value, only to face a downturn later. To combat this, it's essential to develop a clear investment strategy based on your financial goals and risk tolerance. Stick to your plan and avoid making impulsive decisions based on short-term market movements. Remember, investing is a long-term game, and patience is often rewarded. Additionally, many investors neglect the importance of diversification. Putting all your eggs in one basket can be detrimental if that investment underperforms. Diversifying your portfolio across different asset classes such as stocks, bonds, and real estate can help mitigate risk. It's also wise to consider diversifying within asset classes by investing in various sectors or geographic regions. This way, if one investment suffers, others in your portfolio may perform well, balancing out potential losses. Lastly, failing to review and adjust your portfolio regularly is a mistake that can lead to missed opportunities. As market conditions change, your investment strategy may need to be recalibrated. Regularly reviewing your portfolio allows you to assess its performance, realign it with your financial goals, and make necessary adjustments. This practice ensures that you remain proactive rather than reactive in your investment journey. In conclusion, avoiding these common investment mistakes can significantly enhance your chances of achieving financial success. By conducting thorough research, maintaining emotional discipline, diversifying your portfolio, and regularly reviewing your investments, you will be better equipped to navigate the complexities of the financial markets. Remember, informed decisions lead to better outcomes, so take the time to educate yourself and stay committed to your investment strategy. If you found this helpful, please like this video, share it with others who could benefit, and subscribe for more investment tips and financial guidance.